Hello, everybody. Welcome to Wall Street Hackers, one of the most exciting programs on the Pod TV networks, which we discuss the stock market, stock markets in general, stories of the week, quotes of the week, Peter's picks, and of course, a panel discussion, all in a very fast-paced 30 minutes. So with that, we're going to introduce the person who's the host of the show, who's received his bachelor's degree in economics at UCLA, his law degree at the University of Miami, his MBA at New York University, and then slugging out 17 years in New York City in the financial markets, none other than the hacker himself, who is going to wake us up to the latest and greatest problems, Peter Bennett. Peter, welcome to your show.
Welcome, everybody. Hi, Nick. So you can catch a new episode of Wall Street Hackers most weeks, starting Thursdays or Saturdays at 1, depending on your distribution channel. And we always start with the markets, but we're going to flip things around a lot this week. I'm not going to talk, I'm going to use the quotes of the week, which, by the way, were pulled out, all of them, before yesterday's CPI numbers. And the CPI numbers, bottom line, shocked the market a bit because everybody, for a year and a half, I've been saying the market is pretty delusional about how many rate cuts there's going to be. So this week we're going to use the quotes of the week as the market report, and then we're going to skip the 5 most interesting stories, and we're going to dive very deeply into energy and reasonably deeply into pharmaceuticals and tell you my perspectives on those 2 major sectors in the market, obviously. And of course, after the break, we'll give you the dividend pick of the week and our panel discussion. So, selected quotes of the week. Number 1 from Wolf Richter. I follow a lot of different authors. He said, nothing in the jobs report. And again, remember, this was before yesterday's report and the market downturn yesterday. And last I saw it was down today. Who knows what will happen again? I was just telling Nick recently that, even if there's inflation, I'm not saying don't be in the market. You just have to be in the right places because there's only so many alternatives. Munis right now are not paying a whole lot, and Treasuries obviously looking a little better, but you don't want all of your eggs in one basket. So Wolf Richter, nothing in the jobs report indicates the Fed should cut rates. Labor market's plugging along just fine despite 5.5% rates. For the past 12 months, despite the interest rates that the Fed jacked up to 5.25%, nearly 3 million non-farm payroll jobs have been added. Average hourly earnings rose in March, an annualized rate of 4.3%. The labor market rose by 469,000 in March to 167.9 million. The labor force. Second quote from Barron's, again about the payrolls. As for the numbers, non-farm payrolls popped by 303,000 last month, roughly half what economists had predicted, while the unemployment rate ticked down to 3.8% from 3.9%. Again, going the wrong direction. I've been saying for, a year and a half, the Fed is behind the curve. The market is delusional about what's going to happen. And, you hate to say it, but the Fed probably should have raised rates a long time ago and very well may need to raise rates now. I hope it's a tough situation they're in, but I think they're behind the curve, and certainly have been from what I can see. Number 3 from the New York Post, several quotes from the New York Post. U.S. employers increased their payrolls by a whopping 303,000 in March. The monthly figure blew past the 200,000 jobs gains economists expected. Also, they said, this is about Fed Governor Michelle Bowman. In a turnaround from policymakers' earlier statements, Fed Governor Bowman said to a group of Fed watchers in New York that interest rates may even move higher. While it is not my, she said, while it is not my baseline outlook, I continue to see the risk that at future meetings we may need to increase the policy rate further should progress on inflation stall or even reverse. And as I said, Wall Street Hackers have been saying that for a while. The classic, they've been, based on history, not high enough compared to inflation. Usually have to be 2% over at least. And they've been kind of lagging those figures in terms of where they are at in the planning. Finally, so that I'll sum that up and say that's the short run. But here's some situation. But here's the thing about the long run, and this is going to be kind of the bigger concern in the long run. So it's a quote from Jamie Dimon, J.P. Morgan CEO, who's a very sharp guy. I remember when I worked on the street that he was really respected. My boss used to talk about him. He had worked at Merrill Lynch for a while, my boss. Anyway, so Jamie Dimon warned that U.S. interest rates could surge to more than 8% in the coming years as record U.S. debt and international conflicts complicate the fight to tamp down inflation. Quote, huge physical spending, the trillions needed each year for the green economy, the remilitarization of the world, and the restructuring of global trade all are inflationary. These markets seem to be pricing in a 70 to 80% chance of a soft landing. I believe the odds are a lot lower than that. Economically, the worst case scenario would be in stagflation. So, maybe Jamie Dimon is wrong, but he's a pretty sharp guy, and that's what he thinks. And Wall Street Hackers thinks that the future is almost certainly stagflation or inflation. And we'll be discussing government spending in the panel discussion of the week, but that's where we see, and I think investors, as an investor, you better prepare for that, stagflation or inflation, because I think it's inevitable with everything going on. So what to do section, we will cover that quickly before we get into the specifics of energy and pharma. First, our usual advice every week, and it's been pretty good. Own energy producers and pipelines, and also whatever stocks allocation you do have should be in dividend stocks. Our favorite chart, we talk about it pretty much every week. For 50 years to 2022, dividend stocks doubled the performance of the S&P 500. Dividend growth stocks and initiators tripled the S&P 500 performance. That's tremendous performance. Stocks that had non-dividends hardly earned anything for those 50 years. So it's pretty obvious where you want to allocate whatever you want within the stock market. We say energy, we say dividends, and both. So first, we're going to take our dive into energy. As I said, we've been positive on energy. Other than tech, it's been the place to be for years now. Energy pipelines appear to Wall Street Hackers to be the only or the most likely place where you can get very high yields still, growth and safety. That's what all the most investors want. As a matter of fact, they divide investors into income investors, growth investors, and value investors. And I always sort of joke that all I want is all three in a stock. And I think this is the place to get it, especially our favorites like MPLX and EPD, which we've been in for years and still believe in these companies, especially MPLX, but both of them are tremendous compared to most companies. Also, I believe you have to own some energy producers. Energy producers are a key hedge against other things that might happen. In other words, even if you own dividend stocks, even if you have pipelines, what if energy prices go really high? So we have our model allocation around 4% right now, and that's just in companies that are either royalty trusts that own natural gas and oil, or the big boys, and we'll be talking about those in the next few weeks, where we put that 4%. And so now we go further than we have before on a few points. Here, we're going to discuss three trends. Two are new trends, or newly pointed out trends that are very important for the energy space. Number one, data centers. So basically, AI uses a huge amount of data. It creates very heavy demand. So this is a quote from an article. It says, driven in part by AI, data centers are expected to account for an increasing portion of U.S. electricity usage. Now, this is a study by the Boston Consulting Group, pretty respectable organization. So they're saying in 2020, U.S. Energy consumption was increased by 2% because of AI demand. In 2022, 2.5% was being used by AI. But they're saying by 2030, they're estimating between 6.5% and 7.5% of electricity usage is going to be created by generative AI. So where is that coming from? That's an extra 4.5%, 5.5% of usage on both the grid and in terms of needing power for that. It's not all coming from solar and wind, believe me. So that's the first trend. And the second trend is EVs. Now, you have this huge push for EVs. As a matter of fact, if the Biden administration regulations stay in place, it's going to be very hard to buy a gas-powered car in 2030, or extremely expensive. And trucks are going to be phased out by 2032. And so there won't be new gas-powered cars. So I don't think that's going to work well, but not unless technology improves a lot in the meantime. And it hasn't so far, as we know. But lots of flaws, obviously, in EVs that have been brought up, including in Minnesota, where people couldn't get their battery started because it was too cold, people having problem making trips because they couldn't get stations. EVs have a lot of problems, including, I have to go in to mention, the most unbelievable thing is they're probably marginal on the environment anyway, because each battery requires 500,000 pounds of mining just for one battery. And all that mining uses a lot of fossil fuels. So the other thing is their tires, we saw in a recent study, burn rubber, and that's a petroleum product, at 1,800 times the rate as regular cars, because the EVs weigh 1,000 pounds. So they not only create carbon that way, but they also create a lot of pollution. So let's forget about that. The key point we're focused on is electricity. So EVs use a lot of electricity. Obviously, you're pumping it into the battery. So Elon Musk, I believe he said that he expects EVs to eventually require twice the power that's being used right now in the United States and the world, I guess. So I don't know what he was talking about, but he said EVs are going to double the need for electricity. So I know specifically, here's a quote from the Williams, and Williams is the largest energy provider in terms of natural gas in the United States. Huge company. I've been in that, occasionally owned it. And this is from the president and CEO, Alan Armstrong, and he should know. He said, quote, electricity demand is experiencing 3 times faster growth per year this decade than what we've seen in previous decades, driven by the increase in EVs, he actually said in electric vehicles, and the emergence of new large load data centers. So these are the 2 trends I was just highlighting. And this is, again, guy who should know, he's in charge of Williams. So he's talking about this trend, which is concerning in many ways, as a footnote. 1, on the grid, 2, on pollution, on so much. Anyway, but from an investor standpoint, it's an important trend. And finally, this trend isn't new, but people don't talk about it a lot. But even though cars are becoming more efficient in terms of electricity, pollution, and gas mileage too, in the developing world, in the developed world, there's a huge demand for new cars. People want to heat their homes, and they want energy to cook with. And it's pretty hard to say, no, we don't want to give you that. And so that demand with growing populations in Africa and other places, growing demand in China, this is offsetting what the developed world is doing. So they're trying to save here, but the demand for power is huge, and it's likely to continue so. So this is why we love energy. In terms of big pharma, we'll go briefly into that because Wall Street Hackers has never been a big investor in big pharma for some of these reasons, and especially the third one, which I'll discuss. But we did suggest GDX. If I was going to be in big pharma, I guess GDX, which is a Gabelli fund, has some nice leverage, and they have their big discount. We had a small allocation, but I'm not even in there anymore. Just don't need it. So here's the points about big pharma. First of all, this might say it all. This is Barron's cover from Sunday. And what does it say? Big pharma's uncertain future. So it says, obesity treatments aside, drug stocks have trailed the market for years. The coming wave of patent expirations won't make things any easier. So that's the first point. And here's 2 quotes from the article. It isn't a Pfizer problem. Most big pharma stocks have struggled in recent years. Decades of efforts by these companies haven't changed a fundamental truth. Drug makers eventually lose exclusive rights to their best inventions. One other quote from that article, Pfizer, Merck, Johnson & Johnson, and Bristol Myers Squibb have all trailed the S&P 500 over the past 5, 10, 15, and 20-year periods, even if you take into account their generous dividends. So that's not been the place to be. You're talking about even though, and some of them pay dividends, but why own something that trails the S&P 500? And the third problem, which I think is the bigger problem, which is the one I'm most concerned with for the drug companies, there are gigantic Medicare deficits. I mean, they're unbelievably unfathomable. We'll be talking about that in the government section, by the way, so you'll hear about that. But if you have 125 trillion in deficits, and a lot of that's Medicare, then Medicare is going to be looking to save money, and they're going to be looking everywhere they possibly can, and they're going to be fighting with drug companies, as they've begun to do, in terms of requiring bigger discounts, and because they need to do everything they possibly can to manage this almost unfathomable debt. So that is why we love energy, especially pipelines. By the way, I just want to mention this too, that about 4% energy producers totally will be going to that, one of them now, but about 25% pipelines. It's grown nicely, and I'm not getting out of it, maybe more, and no pharma. So we'll take a quick advertisement. We'll be back with the dividend pick of the week, and we will have our panel discussion. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Culiet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you in your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
So, of course, we're going to go with a energy stock this week, although plenty of times we don't. But next week or two, I'll be discussing how I allocate those producer 4%. And then we'll get into other sectors, some bond suggestions, some non-energy dividend stocks in the coming weeks during the spring. So disclosures, Wall Street Hackers is only for entertainment, no guarantees. Nobody can ever give you a guarantee on an investment, especially against inflation. These are only our opinions, and consult your financial advisor. So we previously recommended, not that long ago, maybe 2 months ago, STR CDO Royalty Corp. And at that time, we said 2.5%. Well, it went up about 25% since February. And so we just brought it down to 1%. It just ran up too high. The dividend yield went under 8%. And it does have a lot of advantages. It's solid. So I can't find the perfect 4%, but so that's 1%. And by the way, Kimball Royalty Trust, which I won't be going to, is still 2.5%. And they're very similar. So what do I like about both companies, really, but specifically CDO is what I'm going to be talking about. But Kimball is very similar, KRP. So CDO Royalty Corp acquires, owns, and manages mineral and royalty interests across premium basins in the United States. The company leases its mineral interests to oil and gas exploration and production E&P companies. So I like that. You know, it's U.S. based. I feel, despite the huge U.S. debts, that I want a U.S. centric portfolio, and it's proven true for years. The dividends can receive favorable tax treatment in terms of dividend treatment or return of capital. And that first one, of course, if you're in the United States, that depends what country you're in. It has current yield of almost 8%. It has a very low debt. So its debt to assets was only 0.18%. So you're really just getting the flow of from the cash flow from the oil investments. It's about 85% based on crude oil sales. And that's very hard to find. A lot of energy companies are 50-50. And I like crude more than natural gas right now, although I think natural gas is going to be coming back in the next few years. It pays 65% of its cash flow as a dividend. So basically it just calculates. It says, this is our cash flow. We're going to pay 65%. Based on that, because I can't get good cash flow numbers from TD Ameritrade or E-Trade, but or anywhere that I could find. But basically, since they're paying 65%, it probably has a cash flow earnings of 12, but it is highly leveraged to oil. Now, the bottom line is the S&P, I believe, is only about 2% energy totally. So oil is a very important hedge against a lot of things, inflation, stagflation, probably. And so it's good to have that. And I think it, as I said, also hedges the pipelines, because those pipelines are very safe. But I guess if oil goes up high enough, maybe people will stop even using so much. But they're demand driven. So mainly I go with the pipelines. It's an important hedge. And I think if everybody should have some energy producers to balance their dividend stocks and other investments. So now we'll get into the panel discussion of the week. We started talking about that. Nick, you must be around coming in.
I'm here. Yeah.
So the question is, and this is a serious question, do politicians think excessive spending doesn't really matter? And first, background. So there was a theory called modern monetary theory. It's still out there, that was embraced, especially by many economic liberals and liberals. Alexandria Ocasio-Cortez proclaimed it absolutely must be a larger part of our conversation on government spending. The most fundamental principle of MMT is that our government does not have to watch its wallet like everyday households. MMT contends that the government can spend as much as it wants on various projects because then it can always print more money to pay for its agenda. Right now, the separate point is right now the media, even conservative media, keeps saying the U.S. debt is 34 trillion, and you're like, wow, 34 trillion. But in fact, it very arguably, and it's a much more accurate estimate, is already 125 trillion. How do I get there? Very easily. The U.S. government has taken all the money that was supposed to be set aside for Medicare and some of the money that was supposed to guarantee Social Security, and it's all spent. They've been spending it every year. The problem is the bills are going to become due. You say, oh no, the United States is in terrible shape, but I'll invest in the rest of the world. Problem is the rest of the world is as bad or worse. Look, these other countries, I've looked at countries in China, I've looked at China, I've looked at countries in Asia, I've looked at South America, I've looked at Europe. These countries are offering free healthcare, totally free. At least in the United States, you have not fully free. They give free hospital under Part A, but there's parts that the individual pays for. But these countries have promised free healthcare for very aging populations, and they have put probably no money aside for that. And they also have underfunded pensions systems that are very similar to Social Security, depending on the country, that are also about equally underfunded, depending on the country, some more, some a little less. But these are gigantic numbers. If you look at 125 trillion, just in the United States alone, not counting the rest of the world, that is more money than the U.S. stock market, bond market, and privately held real estate combined. Let me repeat that. That's more money than the entire U.S. stock market, government, the U.S. bond market, and U.S. privately held real estate combined. And that's just the United States, what they owe. The U.S. and other countries won't be able to tax that much money. First of all, there isn't that much money. And second of all, and this has been a debate forever, I don't know why, when you raise taxes, you hurt government revenues in many cases because you start slowing down the economy. So it's not as simple as just raising taxes. So, Nick, do politicians really think excess spending doesn't matter?
I think the answer to that is quite simple. Some of them do, and some of them don't. Some of them are totally aware that we're on what they call a treadmill to hell. And let's take a look at this treadmill and let's find our future in hell. Here's the treadmill. The national debt is 33 trillion. It adds 1 trillion every 100 days. That is not a good metric.
That's the on the books debt again, and that's enough right there, right?
Correct. This is just on the books. It doesn't count
90
Medicare, and it doesn't count Medicare, and it doesn't count Social Security, which are both scheduled to go bust in this decade, and the other one next decade. So the politicians, some of them are aware of it. Some of them believe they can spend their way out of it, but it just isn't going to happen. What you look at is this. Here's another metric. Interest on the national debt is now our largest budget item. It used to be in the national defense. Used to be. It's now all your money goes to pay interest on a debt. And what do we get for it? As David Walker said, nothing. And so this is not also another good metric. So as you go through the budget, which we try, I'll have to show it again because we're not required to read the budget ever, and it should be the number one item that everybody reads. The new budget proposal by the Biden administration will add another 1.7 trillion in debt, bringing over a period of time, our debt to GDP ratio at 116%, the largest it's ever been, 116%. And that does not include the deficit and debt in Social Security and Medicare. So what does it mean? Here's what it means. Politicians will do nothing because you either have to raise taxes, not popular with the Republicans, decrease spending, not popular with the Democrats, or do both, not popular with either party.
Or print money. And you know what? We only have 45 seconds left.
That's basically what they're going to do. And so when they do that, what does it create? Inflation.
Right.
So now everybody's going to pay for it. And your economy in the United States is going to be similar to Venezuela. And
no, I don't think it'll be that bad. But you know, Nick, we're going to have to go because we only have 20 seconds. So we're going to have to continue this next week. We usually try to get it all in, but there's so much information. So next week, I'll try to shorten some other sections so we can finish this up because I do have some conclusions. Bottom line, this is going to have an impact. They're crazy if they don't. Thanks for watching Wall Street Hackers. We'll see you next week. As Kim always says, get healthy, get wealthy.
I would agree.
See you soon.
All right. We'll see you next week. Bye-bye.